Be Wealthy and Smart, episode 594.
I'm gonna live the rich life, full and best life. So if y'all know what I mean, put your hands up and declare with me. Yeah, I'm full of it. I'm gonna live the good life, beautiful and glorious life.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about what's wrong with target date funds. And this is something that I've been wanting to talk about for a while. I have talked about in the past why I don't like target date funds, but it really is an epidemic that these target date funds have become the default choice in 401k plans, in many 401k plans, not all. And it really is concerning, not only because they have high fees, but also because they're probably going to guarantee you subpar performance, that is a lower compounding rate. And as you know, here we talk about compounding at the highest rate possible. So there are some real concerns about these target date funds. Unfortunately, the investment industry is very pro target date funds. And one of the reasons is because the fees are very high on these funds. So they're collecting fees not only on the underlying mutual funds that the money's invested in, but there's another layer for managing these funds within the target fund and for changing the percentages of the funds as you age, which is what a target fund does. It supposedly moves it more conservative as you age. Well, in the investing world, more conservative means moving from stocks toward bonds or cash. The problem is that bonds can be extremely risky, but they haven't been for the last, say, 30 years, really, because when interest rates are declining, that boosts the value of bonds. But when interest rates rise, bond valuations decline. Well, guess what? We've been in a declining interest rate market for 30 years, which means bonds have done extremely well. When you look in the rearview mirror, the performance is fantastic. And you might be looking at the past 5 or 10 years saying, wow, this mutual fund looks really great. I want to invest in this bond fund. But you're not looking forward and realizing that the risk isn't the same going forward as it's been in the past. Because in a declining interest rate environment, as I said, you get a boost in valuation. But now that interest rates are at historical lows, once they start to rise again, then that means that bond valuations will decline. Therefore, having a lot of bonds in your portfolio can actually be very risky if and when interest rates start to rise. And that's something that we don't talk about enough. Target date funds don't take into account. And so the fact that you're going to be moving more into bonds as you get closer to retirement could be putting you more at risk. So having this automatic allocation in a target fund, moving you away from stocks toward bonds as you get older, is something you're getting charged a lot of fees to have happen, which is going to cause you to have subpar performance. You're not going to have as much money in your account over time because of those larger fees. But then you're also potentially being subjected to more risk when the idea is to move you away from risk as you get closer to retirement. The longer the term of the bond, let's say 30 years versus a short-term bond of under 3 years, has a different level of risk. The longer-term bond has more risk. In other words, it'll have more swing or volatility if interest rates rise, versus a shorter-term bond won't decline as much if interest rates rise. But you're also getting less interest in a shorter-term bond versus more interest generally for taking a position in a longer term bond, meaning the longer you invest, the more interest you're able to get. Just like in a CD in the bank, if you lock it in for 5 years, you get a higher interest rate than if you lock it in for 1 year. It's the same kind of idea with bonds. The longer that you invest, generally the higher the interest rate that you get. So in curating my article for today, it took me a while to find an article that really shares my view of the risk of target date funds. But this one I found from Lifehacker. It was written by Alicia Adamseek. So here's what it says. Auto-enrollment has proven to be an effective way for employees to save for retirement, with 91% of those who are auto-enrolled in a defined contribution plan, like a 401k, remaining opted into the program, according to a 2018 report from Fidelity. All right, so I want to pause right there and say 91% of people who are automatically enrolled, they call it auto-enroll. So when you sign up for your 401k, there could be an automatic option that just puts you into a target date fund and selects it for you. And it's saying 91% of people who are automatically enrolled in target date funds stay in them, according to the Fidelity report. The article goes on to say, but that has implications beyond more people saving for retirement. It also affects what funds and investments employees enroll in. Auto-enrollment plans work on inertia. Because 98% of employers offer target date funds in defined contribution plans, and 89% use them as the default investment option, that means more and more everyday investors are putting ever more of their investments into target date funds. I want to pause there and say that's exactly why I'm concerned. Because it is the default, you're being automatically put in there. You might not realize what you've been put into, and you've been put into something with high fees that's almost going to guarantee that you have worse performance. The article goes on to say, in fact, 68% of millennials are 100% invested in a target date fund, due in part to being auto-enrolled in their 401k and defaulted into the option, reports Fidelity. Overall, more than 30% of 401k assets are in target date funds, a dramatic increase from around 10% in 2008. And 403b plan participants have an even greater portion of assets involved in target date funds. All right. 68% of millennials are 100% invested in target date funds. These are our young people who have time on their side and have the opportunity to compound higher by having more of their portfolio in equities or stocks. Yet by choosing a target date fund, you're typically, again, sacrificing performance, paying high fees, not being asset allocated in the way that you're choosing, and this may be detrimental to you over the long term. It goes on to say, essentially, target date funds take an investor's age and projected retirement year into account when picking investments. For beginning investors, they are an easy and manageable way to ensure exposure to an array of investments and spend less time researching and picking out individual funds. They have low minimum initial investments, automatic rebalancing, and adjust asset allocation for you over time. They're simple and don't require a lot of investing savvy. Well, that's exactly what's happening. They're taking advantage of people that don't have investing savvy. And because you might not be aware how to choose your own investments, they're choosing them for you. And guess what? Putting them into high fee funds. There's some lingo here that I want to explain. When they say low minimum initial investments, that just means that some funds require that you have $500 or $1,000 as a minimum to invest in. So you have to have enough money to be able to choose different funds. Automatic rebalancing means usually on a quarterly basis, whatever pieces of pie you've chosen will be brought back to those original percentages. So maybe you have 4 investments, 25% in each one of those investments. One investment grows to 35%, another shrinks to 10% of your overall allocation, just because some do better than others. Every quarter, they'll bring it back to 25% in 4 investments. So they'll sell what's done well, they'll buy more of what's done poorly, and you will get back to 4 pieces of 25% in your portfolio. The article goes on to say they're simple and don't require a lot of investing savvy. But beyond that, target date funds lose some of their luster. Once you've started building your assets, you should look into switching out of them. For one, because when you're in a target date fund, you are not in control of how that fund is invested, says D. Keith Lockyer, investment market manager at PNC Wealth Management. Your individual risk tolerance is not taken into account, meaning especially for older investors, that your portfolio is likely too conservative. You could also argue this is the case for young investors who don't need as much exposure to bonds as they're likely getting. Outside of a target date fund, you or a professional can tweak things how you'd like in better funds. Target date funds are a turn off my brain kind of thing, but when we turn off our brains, bad things happen, says Scott Tucker, president of Scott Tucker Solutions in Chicago, Illinois. People are using target date funds for growth, and the problem is those target date funds have a lot of bonds in them, and bonds lose value when interest rates rise, meaning people looking to retire soon, say by 2025 or even 2030, are potentially losing out on a lot of growth by staying invested in them. And that's exactly my point. You're losing out on a lot of growth, a lot of potential extra compounding, basically a lot of extra money that could be in your account by staying in these target date funds. The article goes on to say they're also actively managed, which LH advises against, which means they come saddled with more fees than your typical index fund. One big fee difference, the expense ratio. The Motley Fool reports that the difference between a target date fund's annual expense ratio and an index fund's is 0.51% versus 0.09% on average, according to the Investment Company Institute. That might not sound like a lot to get worked up over, but take this simple example. You put away $5,500 a year for the next 30 years. Your funds earn 7% annually above inflation before fees, around the stock market's historical average. In the index fund scenario, that is a 0.09% expense ratio, you'll end with just over $511,000. If you pay that higher 0.51 expense ratio, then, all other things being equal, you'll have a little over $474,000 in savings instead, a loss of about $37,000 because of those extra fees. That said, fees for these funds can easily reach 1% or higher, which will eat away even more of your money. You always need to check the fees before investing in any product. One solution for older investors who are 59 and a half plus and those who have left a job is to roll their 401ks into IRAs, says Tucker. You have better investment options that way, and young investors should choose the highest retirement year on the target funds they can, he suggests, even if that's not necessarily the year they want to retire, so that they're more heavily invested in equities and have less in bonds. We're trying to make investing simple for people with target date funds, but investors are going to want to look under the hood, says Tucker. The easy button isn't always the best option. End of article. Well, and that's my point. The easy button isn't the best option, and investment companies are getting away with charging you extra layers of fees that you don't need. If you don't know how to set up your asset allocation and how to choose funds in your investment account, listen to some of my podcasts about asset allocation. It's really not difficult. It takes about 5 minutes, and rather than paying $37,000 or more over your lifetime, I think you can take 5 minutes and it's well worth your time to do it yourself. So beware if you have target date funds in your account, no matter what your age. It's best to be educated, be in control of choosing your investments, and know why you've selected them and what you have in your portfolio. This is going to empower you to perhaps not have just $37,000 more in your account, but hundreds of thousands of dollars more in your account over time. It's worth taking a few extra moments and getting educated on this. This is one of those things you don't want to turn off your brain about. It's one of those things that's easy to do yourself and will pay you handsomely when you make your own choices. If you want to learn more about asset allocation, I also suggest that you read my book, You're Already a Wealth Heiress, Now Think and Act Like One, 6 Practical Steps to Make It a Reality Now. Whether you're male or female, this book applies to you because it's all about wealth building, which is not gender-based. It applies to both. And I explain the importance of compounding and the importance of maximizing your compounding and how much of a difference that's going to make over your lifetime to get this right. And easy instructions how to make it simple. There's a link in the show notes to my book to make it easy for you. If you haven't subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be updated as soon as new podcasts are available. And if you'd like to know more about my inner investing circle, the Be Wealthy and Smart VIP experience, fill out the short questionnaire in the show notes, and we'll set up a mutually convenient time to talk and see if it's a good fit for both of us. And don't forget, the full library of all of my podcasts are on my website, not on iTunes. iTunes only has the latest 300. So there's another 300 over on my website at lindapjones.com/podcasts. There's a search box in the upper right corner. You can search for asset allocation. You can search for debt, any term that interests you, and all of the podcasts related to that will be pulled up for easy reference. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.